Several investment managers and billionaires have warned of an impending economic slowdown in recent months. Chamath, a billionaire hedge fund manager, is one of these managers, and he has recently warned about the repercussions of the Fed's activities. We've seen what occurs when the Fed prints huge amounts of money into the economy. Inflation begins to surge, financial markets rose to all-time highs, and speculation reached perilous levels. The Federal Reserve has a significant economic influence. The Fed's reaction to rising prices poses a concern in the future. This is what has so many fund managers, economists, and individual investors are concerned about. This video will explain why Chamath feels inflation is no longer a concern for investors. Investors, according to Chamath, should be looking at a completely other indication. First, if this is your first visit here at the Smart Stocks Academy channel, let me give you my warmest greetings. And to be the first to know when a new video is released, don't forget to hit the like button, subscribe, and the notification bell next to it. So if you're ready, let's get to the video. In an alarming turn of events, the Federal Reserve is steadfast in its commitment to shrinking its balance sheet and hiking interest rates to battle inflation. Millions of individuals throughout the world have declared that inflation is not a passing fad, but it appears that those fears were self-inflicted. Because of the predominance of such viewpoints, the Fed has become excessively hawkish. The Feds may be overreacting again, but on the opposite end of the spectrum, as it did in March of 2020. Chamath argues that inflation may be more ephemeral than many assume, owing to the Fed's tendency to overreact. Jeremy Grantham, a well-known financier, has predicted a market meltdown for America's mega bubble. Grantham described how COVID, money printing, surprise inflation, and the promise of increased interest rates stabbed the market. The term super bubble is adopted because Grantham described 2020 as an epic bubble. He also referred to 2021 as another bubble. As a result, we are now in a bubble squared or a super bubble. I don't listen to Jeremy Grantham because he is basically a broken clock. But a broken clock tells the same time every day and is correct twice a day. In Grantham's case, it is questionable whether his money matches his words. Grantham does, however, discuss solid points from time to time. By all accounts, the US economy is in a bad shape. Chamath believes that the Fed will likely overreact, perhaps causing the US to enter a recession. The government printed $10 trillion and the stock market has also corrected $10 trillion. If shares continue to fall due to rising interest rates, the net money outflow might eventually become negative. This is clear from the fact that growth stocks and cryptocurrencies have collapsed dramatically in recent months. David Sachs, a well-known venture capitalist, detailed why a recession is pending in the All In podcast on January 22nd, to which Chamath concurred.
You know, we had Jeremy Grantham as sort of a
old school
kind of bearish type market commentator. He had this expression that it's more one of these stop clock right twice a day things.
Jeremy Grantham has never found a market he didn't name.
Yeah, exactly. But a stop clock can be right twice a day. And the line he had today is that we're seeing the popping of a super bubble. And we've been talking about
super bubble.
Yeah,
evocative.
Exactly. Basically,
but that's not true. But I mean, it's good.
Yes,
well,
it's evocative.
Well, the sense in which it might be true
Super
is
bubble.
that we've talked about this last few months. Is that you had the Fed and the federal government pump a $10 trillion of liquidity into the market over the past 2 years because of COVID. Now they're starting to pull that back. And there was, I think, a general asset inflation across asset classes. Certain types of assets clearly got more inflated than others. We've seen a huge correction in growth stocks. We've seen a huge correction in crypto. Basically anything long dated, as the fear of interest rates increasing has gone up, they've massively corrected. But so the concern is that, with the losses we're seeing, and every day I keep seeing more red, that this could turn into a recession. Popping of bubbles is usually followed by a recession. So I think, the fortunes of the economy could turn really quickly here. And
that is the marginal risk. The marginal risk is actually for a recession. We talked about this before. By the way, just to your point, you're right that we pumped in $10 trillion, but over the last 3 weeks, and really over the last 2.5 months, we have actually eviscerated $10 trillion of value as well. So if you want to measure it, we put 10 trillion of excess capital in, but we've now destroyed $10 trillion of equity.
Destroyed it by lowering the prices or repricing stuff. Yeah, we've repriced
equity,
everything.
crypto. I mean, crypto in the last couple of days has just been shellacked. Growth stocks have been shellacked. Biotech stocks have been just absolutely smoked.
The bifurcation or divide in the global economy is the most critical element pointing to a future recession. You could believe that interest rates are rising all throughout the world, but this is not the truth. While the US Federal Reserve has been rising interest rates, China has been decreasing them. This is problematic for one reason. Boosting interest rates by the Feds might indirectly destroy China's economy, which is already struggling. Because China accounts for such a large portion of the global economy, a collapse in China's economy would harm the American economy as well. This is dangerous since China's property market is presently experiencing significant deleveraging. Deleveraging occurs when a company reduces its debts by quickly selling assets. This has not only happened with Evergrande, China's largest real estate developer, but also with a number of other firms. At the same time, China is being affected by Omicron, since the Chinese government has been exceedingly tight on shutdowns. As a result of these two reasons, China's economic development is fast declining. In reaction, Chinese policymakers are worried. We need a reasonably flexible monetary policy. Yu Yongding, an economist who formerly advised the People's Bank of China, told Reuters. How much we relax depends on economic conditions, but the policy direction is obvious. The People's Bank of China is also expected to reduce the bank's reserve requirement ratio soon. The portion of deposits that the banks must retain is known as the Reserve Requirement Ratio, or RRR. The reserve requirement in this scenario is 8%. If the reserve requirement falls to 6%, the bank can loan out or invest 2% of its excess reserves. If the RRR rises above 10%, banks will be forced to sell a portion of their assets to fulfill the requirement. China's reserve requirement was formerly 12% before being reduced to 11.5% in December of 2021. That implies banks now have a 0.5% extra capital to invest or lend. This action indicates that the Chinese economy is in trouble and that big financial infusions are required to keep the economy going. According to an alleged Chinese policy source who spoke to Reuters, we must surely relax policy, since the economic downturn is relatively severe. According to Lian Ping, chief economist at Zixin Investment, 1 or 2 additional RRR reductions are likely this year. This may seem like a lot, but other analysts, such as Zhu Hongkai, deputy director of the Chinese Economic Policy Commission, predict even greater turbulence. According to Zhu Hongkai, the RRR will be reduced by at least 3 times by 2022. The US Federal Reserve is one of the reasons why additional rate cuts may be required. The value of the US dollar will rise when the Fed raises interest rates. This is due to the better comparative rewards of keeping the dollar. As a result, people would keep more dollars than the Chinese yuan. Furthermore, when the Chinese government cuts interest rates, the yuan falls. This is bad for the Chinese yuan since investors and institutions have been selling it for US dollars. So when the Fed raises rates and the Chinese government lowers rates, the US currency rises and the Chinese yuan falls. This places significant strain on the People's Bank of China. The PBOC insists that it would concentrate on its own economic crisis, but analysts across the world believe that it will not have a choice. A similar situation occurred back in 2018, resulting in a modest manufacturing slowdown. During this time, China's economy saw its worst growth in 28 years. So how did all of this come to be? In the midst of a trade war, Jerome Powell hiked interest rates in 2018, forcing the Chinese economy to decelerate significantly. As a result of the worldwide economic slowdown, the Fed was obliged to decrease interest rates in 2019. As a result, US manufacturing production plummeted, and the country entered a minor recession. We are presently in a scenario comparable to the 2018 recession, or it could be worse.
The risk, in my opinion, is not of runaway inflation anymore. And the reason was what happened this weekend was incredibly important. And we have seen this happen just a few years ago. So this weekend, China cut interest rates. Now, as we know, we are dealing in the United States with this issue of whether we should raise rates and by how much, because we're worried about inflation. Well, if you're cutting rates, it's because you're worried about the other problem, which is that the economy is basically turned over and you need to become more accommodating, right? You need to incentivize businesses to spend by lowering.
By turned over, you mean it's slowed down. People are not building, companies not doing new projects. So you want to give them an incentive or maybe some catalyst to start some new company or start some new project because all their real estate projects have wound down.
In 2018, here's exactly what happened. The setup was the Fed, everybody was worried about what the Fed was going to do on interest rates. The Fed was looking at China as the canary in the coal mine, the leading indicator of what we should do. And at the end of 2018, Jerome Powell decided to raise rates. And we raised rates. And then enter 2019, and the Chinese economy turned over. And we realized that their economy was not nearly as strong as we thought it would be. And so our reaction was disproportionate to what the actual data on the ground said. We entered a recession in 2019. That's when you guys probably saw Trump going crazy, blaming Powell. I mean, most of us ignored it because, we were all dealing with, Trump derangement syndrome. But the underlying thing of what he was saying was, hey, hold on a second. You just caused a recession in America by raising too quickly. The Fed is now in this really delicate situation where China cut rates last week. We have an FOMC meeting, the Open Markets Committee that sets rates, on Wednesday, I think, of this coming week. What is he supposed to do?
Chamath got even more gloomy 1 week after predicting a recession. This is because, in addition to China, Germany is experiencing a downturn. Germany reduced its GDP growth prediction for 2022 to 3.6% from 4.1% previously. Germany's continuous battle with the epidemic, according to the German Economic Minister Robert Habeck, is one of the key causes of the slowdown. Germany's National Statistics Office likewise forecasted a 0.5 to 1% fall in output in the fourth quarter of 2021. This may not seem like much, but when annualized, the drop would be 2 to 4%. This is significant because the Feds may be too enthusiastic about the US economy. Perhaps the economy isn't as robust as the Fed believes, and that rate rises will bring the US economy crashing down. China and Germany have already signaled that the economy may be weaker than predicted.
The FOMC meeting happened this week, and Powell basically said, look, we're going to start tightening in March. I think the way that he said it, all of these words tend to be so scrutinized and overanalyzed, but instead of figuring out what people thought, I think their actions post the FOMC are important, which is that, we effectively now started to price in about 5 rate hikes this year. So probably 5 25-point rate hikes. Effectively, that's what the yield curve tells us. If you take a big step back, I just want to remind people, it's really hard to live through volatility, right? And we're in a phase of it now. But typically these big drawdowns, so when stocks go down, it actually precedes, so it comes before the actual starting of a rate hike cycle. And so if you go back to from 1950 onwards today, every time the government has started to raise rates or the Federal Reserve has started to raise rates, the stock markets have actually rallied. Now, why is that? It's typically that they see through the end of the rate hike cycle and they start to price the business as if these rate hikes are done and to rebase things. And on average, I think the stock markets go up between 7 and 8%. So call it 7.5%, 8.5%. And so what's interesting to me is now we're finally starting the process of these hikes. And the real question is going to be, how data dependent do these guys get?
Chamath referenced a meeting of the Federal Reserve Open Market Committee, or FOMC. During the meeting, Fed Chair Jerome Powell reiterated his commitment to increasing interest rates and reducing asset repurchases. This strongly confirms Chamath's viewpoint. Some investors may believe that when the Fed raises interest rates, the market will be approaching its bottom. That, however, is not the case. Market pricing is forward-looking and hence account for future occurrences. According to the efficient market hypothesis, the market is reasonably efficient, and that all asset values reflect the available information. That notion is not entirely correct, but it is still applicable to some extent. Investors are aware that the rate rises are imminent and that the market is reflecting this. Chamath discovered that when interest rates are raised, the market tends to rise. However, rate rises may already be priced in, and it is time to begin dollar cost averaging into the market.
Bill Ackman 2 weeks ago was advocating for a 50 basis point raise in this meeting. So that's way beyond what people even thought is supposed to happen.
We should just remember that Bill Ackman has bets, macroeconomic bets in the market. If he's calling for a 50-point raise, I guarantee you,
he's going to make a lot of money.
He'll make a lot of money if there's a 50-point raise.
No conflict, no interest. Yeah.
Exactly.
But my only point is the setup is a very complicated one for the Fed coming into this week. And the risk is to a recession, because if we overcorrect,
yes,
and the leading indicators all around the world tell us that their economies are weak, then inflation may have actually been much more transitory than we thought. And right now we have to decide, because if we overcorrect, we're going to plunge the United States economy into a recession.
Raising interest rates is vital to reduce inflation, but it has disastrous repercussions. Powell's vehement comments confirmed Chamath's view that inflation will be ephemeral. The global economy is weak. As China has shown, inflation may soon decline as the economy weakens. Bill Ackman, a well-known hedge fund investor, has been putting pressure on the Federal Reserve to hike interest rates even more than predicted. Ackman has a bond short position and would gain if the Feds listened to him. However, this is hardly surprising, given Bill Ackman's reputation for market manipulation. He spoke on CNBC in March of 2020 about how COVID was going to worsen, while cashing off his short position and entering the market long.
The bottom of the market, and it was a phrase something like, when we shoot the generals, and his comment was the generals are big tech. When those things trade down 25%, the bottom is in. And I think that collectively, most people think that we're a little bit oversold in all areas except big tech. I think big tech is down 10, 11, 12%. When you see this thing really get cracked is when those folks, trade down another 10 or 15%. And then I think we're kind of through most of the pain.
So Peloton and Zoom were kind of mid-tech. I don't know what we call those, but I would call them like mid-tech. They're obviously not big tech, but they're not small either. Mid-tech gets their asses kicked 50 to 80%. Big tech, 15%. But if big tech goes down 30%, then we start really seeing a bottom. And we consider Netflix part of that?
You'll ever see that, because I think big tech, you have to remember, is basically the index. And in the last 10 or 20 years, you've never seen drawdowns more than 15 to 25%. You've never seen it. And when you've ever had a 15 to 25% drawdown, meaning the market goes off 15 or 25%, you have to remember the thing that we have also done over the last 20 years is created so much money on the sidelines, always looking for a cheap buying opportunity. And so the minute that these things, so even, March of 2020, remember when we started to do this pod and it literally looked like the world was ending?
Yeah.
The bottom existed for a week.
Yep.
And then within a week, the entire 25% loss in the stock market was wiped out and we were back to normal.
So, we know that the economy may enter a recession, but this does not always imply a massive market catastrophe. The minor recession that America faced in 2018 resulted in a 17% drop in the S&P 500. That is not too much. One of the reasons for this is that there is a lot of money sitting on the sidelines. Total deposits at all depository institutions have risen to more than $11 trillion over the last decade. That is a large sum of money, and a significant portion of it is awaiting a purchasing chance. Even if the market drops as much as it did during COVID, it will most likely recover soon due to the funds ready to purchase the dip. Not only that, but several tech stocks have already fallen precipitously by at least 50% from their highs. This rate of decrease is comparable to prior economic calamities. As a result, the market's bottom may be close at hand. Chamath believes that if large tech falls another 10 to 15%, the market bottom will be imminent. This is intriguing in light of previous occurrences. We've seen Meta drop 26% in a single day, which is a clear indicator that big tech isn't as powerful as many expected. Chamath benefited greatly from this occurrence. In a recent video, I discussed Chamath's long position in Google and Microsoft, while selling short Meta, Amazon, Apple, and Netflix.
You're bringing up a really important effect of all of this, which is what happens now in 6 or 9 months, to your point, when the consumption of hard physical assets turns towards the consumption of services, which it typically does, right? If you revert back to the mean here, people aren't going to be buying as many Pelotons and all of that stuff because they bought them all, right? They bought all the physical goods they need. And to your point, these companies have over-ordered all this inventory. Actually, Peloton is a perfect example because they basically shut down their entire supply chain at the end of this past quarter and essentially said our inventory turns will be more than enough to meet, existing demand for the foreseeable future. That's an enormous capital problem that these companies now all of a sudden will face, right? So the next step beyond all of the supply chain issues could be, and I think Sachs has been talking about this a lot, like a pretty bad recession if these companies have all this inventory and they don't know how to get working capital.
This spread strategy has recently performed quite well, particularly in light of the recent price declines in Netflix and Meta. To make matters worse, firms have ordered an excessive amount of goods due to supply chain concerns. This is concerning because if consumer demand does not meet the extra inventory that will be available shortly, there will be a tremendous quantity of sitting inventory. This issue has a potential to cause and worsen a recession. Chamath recently spoke on the All In podcast with supply chain specialist Ryan Peterson. Peterson, the CEO of Flexport, explained why he feels firms bought too much inventory. Chamath agreed with this assertion and mentioned a probable recession as a worry.
We have had more activity and hedging than in any other period in recent memory except the great financial crisis. Just to set the tone of where we are in terms of volatility in the capital markets. Mutual funds who don't short stocks, right? The multi-trillion-dollar mutual fund complex whose only job is to buy has been a net seller. Hasn't even started buying a single thing yet.
The fascinating aspect of this market slump is that a major portion of the drop was caused by people hedging their assets. Almost all top-tier fund managers hedged their portfolios in some way. The implementation of these hedges is expected to have a detrimental impact on the market. Buffett, for example, hedges his portfolio using cash, while Cathie Wood, Bill Ackman, and Chamath hedge with short holdings. These hedges have a significant influence on the market and may be the cause of the recent slump. Chamath stated that this is the biggest hedging activity he has witnessed since the 2008 recession. So, do you agree with Chamath? Please share your thoughts in the comments section down below. And with that, today's video comes to a close. If you haven't already, show your love and support for this video by hitting the like button, subscribing, and turning on the notifications next to it to be the first to know when a new video is released. Thank you for taking the time to watch, and we hope you had a wonderful time. We hope to see you again on our next video.